Hey everybody, welcome back to 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Wonderful to see you all once again. I am coming at you guys from Phuket, Thailand today. So I still look like I am on a potato, but wonderful to see everybody. Yeah, so still an interesting week, an interesting day yesterday. We had a little bit of excitement early on, a little excitement later on in the broader market. We'll break some of that down today, as well as take a look at what is looking like, maybe a setup today for some interim volatility, meaning upside volatility. We have a couple of things that are coming together, right? We've been talking this week about we're kind of starting to set up to look like maybe we kind of get this upside volatility like we saw on like August 28th or maybe something like September 20th. We're having some of our data kind of look like we did around then. We're in those types of, we're kind of in those IV conditions, certainly the daily volume conditions. So we'll break some of that down as well. I'll walk you guys through what I'm seeing here. Yeah, so let's hop into it for today. For those of you who are new to the channel, I'm going to be breaking down my daily analytical article. I post this to my X account every day prior to market open. You can find this if you're watching this on YouTube, link down in the description, or you can find it over on my, well, this will lead you over to my X account. If you're watching this on X, obviously it's at the top of the page. So yeah, we do have a couple of short-term reversal signals compounding today. Sent out some thank yous. First off, to today's sponsor, 401 Kool-Aid. Thank you very much for my coffee today. I deeply appreciate it. And thank you, as always, to Dad Scruffdo. Scruffy, thank you so much, as always, for your support. And thank you to everyone who has supported the channel through my Buy Me a Coffee page, through donations, things like this. You help me keep this completely free and open access to everybody, right? I'm not monetized on YouTube or on Twitter. So thank you very much. I appreciate this. So yeah, let's take a look, right? Current context. What are we looking at in terms of SPY? Right, basically kind of a boring day, right? We got these conditions, right? These are the kind of grindy conditions, little dippy dip here, but basically kind of staying around the 604 mark and the 606 mark. Pretty tight range for most of the day. The Fed Goolsby, I don't know what this guy does now, but anyway, somebody named Goolsby who works for the Fed said something about tariffs, and then that meant, oh my gosh, let's dip $4 over Inspire, $3.50, I guess, $3. I'm not going to be a prima donna about this. A bit of a dip, right? Some volatility. And what this illustrates is basically a component that we see going into today. So to keep this in mind, right, obviously I'm not targeting this, right? We're trying to look at the context here, the broader market context, use SPY as kind of a benchmark for this to get a sense of the contextual factors that GameStop is involved in here, right? So there is a large correlation between, right, if we see down days, we see big down days in SPY, generally that translates over to some instability and weakness for one reason or another, probably through ETF outflows that have to do that make it easier to short GameStop, something like that. So we do see a high correlation there. The flip side of that is if we do see very strong days, if we see these kind of upward grindy positive days, call gamma dominant territory, spending most of our time up there over in the broader market. It's not a guarantee, but there is a much higher likelihood that we're not going to see that type of heavy shorting or big dips over in GameStop. So keeping this in mind, right, we do have some kind of slippiness over basically between, it's a little bit above this, basically between like 605. Yeah, 606 is kind of our pretty safe, pretty stable zone between 606, basically all the way up to 610, right? So we've got our call wall over here. So, right, we're working under the assumption here with SPY, based on what we know about trader options trading patterns, retail options trading patterns. And basically, right, when we're moving into these call dominant positions, right, 606 here, for example, and above, these are net call gamma positions, net positive. We're assuming net positive. We're saying, okay, traders are net long these calls. right? Since retail traders are mostly long and mostly trade single leg options by a vast majority, actually by zero DTE by a vast majority. It's a vast majority larger than that for single leg and long options. So we actually assume that most options that are being traded over on SPY are long puts and are long calls. If you go ahead and take a look at our gamma exposure zones, dealer gamma exposure, right? So we're looking at how it's trader positive gamma, so it's dealer negative gamma. So it means that dealers are hedging this position by buying shares when they have negative gamma. What this means is we end up with volatility suppression whenever we trade into these gamma brackets, into these call gamma brackets. When we move into put gamma, so this is territory that is largely defined by trader long puts, dealer short puts. Dealers are selling shares as the price moves down into this territory, right? So rather than opposing the direction of the market momentum, it what would I say? It sympathizes, it sort of harmonizes with that, not harmonizes, but it adds to momentum in the market, which is why we see SPY volatility, volatility in the S&P in general spike whenever we see the price move down, but decrease when we see the price move up. So we get into this call gamma territory. So, right, what we can see here is basically throughout yesterday's trading, below 606 and above something like 601 or 600, right, we kind of have this very neutral. It's not really put dominant. It's not really call dominant. It's pretty neutral. So this neutral range is going to be less stable than the call gamma range we have above us. Right now, we are trading above 606. If we stay above that, we're going to be in that very volatility suppressant area right up until we kind of smack into the 610 call wall. We'll get a test there, see if we punch through that. That will function as a target basically until we punch through that, and then it'll be a question of, okay, how much farther up do we go there? As we could slip around if we kind of dip below 606. It's easy enough to slip us around basically, from 601 kind of up to 605. We can have some volatility in there like we saw yesterday. We don't have real critical volatility basically until 600. If we move below 602, we get kind of close to that 600 level. We may have a little hang up in terms of a put wall, something like that, because of how much put gamma we have there. But if we do move into that pretty heavily, then we should see volatility spike up, and then we'll kind of shoot down basically to like 595, something like that, right? 598, 599. It'll slow down, right? This 597 to 599 area. We'll move through that more slowly than we would say 600 if we go through 600, but volatility will spike and something. That downside moves will happen. Right. My point of pointing this out is we are right now trading above 606 unless we have something to really kind of push us down there. We're looking at some pretty stable conditions today, which is nice to see. Right. Yesterday, in terms of what we looked at for GameStop, right, two moments to kind of call our attention to. Later in the day, we did have, right, so this kind of dip here synchronizes with the Goolsby speech that ended up causing this downside volatility in the broader market. So we can see sometimes there are these moments, not kind of the small stuff. There's not a high degree of beta with the small stuff. But when we do have these bigger volatility events over in the broader market, we can see where, all of a sudden, right, we'll see something very similar in GameStop kind of pop up. So with this move down, basically we were trading for pretty much everything after, about 11 o'clock, was basically confined below the midline of our bearish regression macro channel. We were in the lower channel of our VWAP bands here. So basically between VWAP and 2 standard deviations below average. Most of the time we were kind of hanging out around that 50-minute moving average, which is most of the day that was hanging out at kind of 1 standard deviation below VWAP there, the volume weighted average price. And we only traded down here. We started to move down a little bit, but basically that dip there was the SPY-induced dip, and then we moved back up right to basically that same level we were before this little dip-de-doo, for lack of a better term. The early part of the day, obviously, this was exciting. Ultimator, the Ultimator 7 is really great, regularly about posting Timing and date expectations for computer share recurring buy-ins. So we usually do get a little bit of volatility whenever these occur. These are more important in low volatility conditions. So we probably didn't notice too much of that back when we were trading in these high volatility conditions. The price was up in the 30s. We were trading 13 million shares a day. These probably didn't show up, right? These are, I don't know, 50 to 100,000 shares. I'm guessing it's not a ton of volume, but in low volume and low volatility conditions, it can matter. Certainly based on what we've kind of seen recently. What was really interesting though was before that happened at about 10:22, we got this kind of rocket off the 25 level, right off of the midline of our bearish regression channel, our bearish macro regression channel here, which shot up way above, right? It sort of established, right, blew us out in terms of how our VWAP scheme was looking at that point. We were pretty tightly within that. And as I sort of point out later, I'll stop for a second on this image to point this out to you guys. But what occurred here was, I'm not sure if it was one trader or multiple traders, but it was a pretty steady flow across about a 15-minute window of buying $25 calls that expire today. So somebody came in and bought like 2,000 $25 calls in here, and then it just basically, I think maybe even starting kind of back here, and it just shot us up. So I don't know if this person was trying to buy those like on the down low to try to make money off of the computer share buys. It doesn't look like it, because that person didn't exit that trade. This trade actually, like, at this point versus this point, this trade was up 100%. And then it sold off, and then it traded back up again when the computer share buy-ins filled. So the Ultimator 7 pointed to 1047, which is right here, as the moment that the computer share buys filled. So this person could have gone in here, got up here, got this whole thing shorted down, right? Volatility sold, and then could have sold these for like a 60 to a 70% gain, basically here, or basically through here for like an aggregate of 40 or 50%, something like that. This trader chose not to do that, and that was a serious amount of money, right? That was, I think, probably the average price on that trade was like 45 cents or something. So, $45, 1,000. Yeah, so that's like 90K. That's I mean, maybe it's just a big trader taking a big money to the likes of me, I guess, right? Shouldn't overestimate, I guess, how valuable that money is to a certain trader. But like, it's super down now, right? It's out of the money, so now those 25s are dying. In fact, like, I'll just scroll down. I'll show this. We can visualize this here. Yeah, it was here, right? Yeah, look at that. I mean, we also had some sales. So like, but look, it netted almost 3,000, right? It was netted almost 3,000 here. A bunch came in at the mid. We had a lot at the mid. And then we had quite a few at the bid, but those were mostly kind of spread throughout the day. I don't know, maybe this trader just kind of slowly, see, here's the thing, right? We have kind of equal volume, but based on how much this was, this kind of looks like, this is clearly all at the ask. This is clearly all at the ask. We still end up with 2,856. So is it possible that this trader, exited, a fair bit of this, and like that same number then later in the day kind of spread throughout the whole day, exactly entered in as short calls? I guess that's possible. What I would say this looks to me, based on these buying patterns, is that most of the new OI here was in fact taken from the ask and the mid, and maybe some of this was exited throughout the day. Maybe there were some call sales. There definitely were call sales later. So I think, so for February 21st, for February OPEX, there are a fair number of $25 calls sold. But Yeah, this strikes me as a trader, basically entering this to open heading into today. So somebody may be betting big on something like a decent size reversal. Maybe was betting on something like that yesterday and decided to hold it one more day. I mean, if we don't get it like that, that's gone. I mean, these are already down like 25 or 30% here. So hey, good luck to that guy, whoever opened those. Yeah, so right, a spike up in ask volume, right, in bullish, I should say bullish premium from what we've been seeing. Um, the other thing here too, right? Not sure what to make of this. We didn't really get any. It doesn't look like we got really much shorting yesterday. Shares to borrow stayed pretty common, pretty even at about 1.9 million, but they've popped back up to 2.5 million. So that's the highest we've seen, I think, since January 14th. I think maybe we got up about that high around then. And we did have something like that. We had around 3 million shares to borrow in early November and end of August. Last time we had kind of more than this number was around there. So just before we had the August run on the 28th and the 29th, we had about 3 million shares available to borrow. And in early November, we had around 3 million. And then those kind of trickled down into the later part of the month. So what does this mean? Is that a bullish sign, right? If shares are becoming available at the bottom of a liquidity cycle, like are we, one of these volatility cycles, is that a bullish sign? Is that a bearish sign? I'm not sure. What I'll say at this point is that it doesn't look like anybody's gone ahead and borrowed any of those ahead of time here. No, they're still sitting at 2,500. The borrow fee came down a little bit from 0.38% to 0.32. So what I would say here is, I think, right, basically, my whole point of what I'm saying here today is, and I'll unfold the rest of these components here in a second, is that this is looking like there's some real opportunity for upward, upside volatility. There is something of a recovery potential today, possibly something like $1 to $1.50 gamma ramp up into the 26.50 area. I mean, if this wants to go really crazy, it could go like really crazy. I don't think that's what will happen. I don't think. Honestly, it really depends how short retail traders actually are calls. That's what's determined there, because right, we use our max pain values, right, and we can take a look at this down here. Right, we use our max pain values basically to assess, like, this is usually max pain is true, right, because usually we're assuming that traders are long, both they're net long calls and puts. So when that's the case, market makers will basically, generally, right, they'll maximally benefit. Their maximum profit point is going to be pretty close to where the largest number of calls and puts expire out of the money. Usually, that's very true over on something like SPY, since that's almost always the case that traders are predominantly long calls and long puts. That's not necessarily the case on GameStop, because it does seem like a number of traders do kind of catch wise, not necessarily on the volatility cycles themselves, but there are a lot of short call traders that have piled into this second wave of dipping. Not so much, I think, not so much what we saw, into this consolidation period. A bit of this, we did see a bit of this, but it did seem to me like the options market in general was getting a little bit more aggressive on selling short calls into this week's price action, kind of toward the end of last week too. Right, we saw that a lot of put strikes too. For example, during our consolidation period, we had a lot of put strikes that were uncommonly heavy short puts. So these ended up behaving, or when we look at our gamma landscape, they behave differently than what we usually anticipate. That seems to be the case also with a number of these positions that we're looking at for calls. Now it's kind of difficult for me to track this, right? I'm just one guy. Like, I try to keep all this in my head. I try to write this down, but there's only so many hours that I have to kind of look at this data and keep track of this. So that's kind of what I've been seeing generally. I could be wrong on this. And because the volume, because the kind of the OI there is so, sometimes it's mixed, right? Depending on the days, like it's kind of hard to keep a running tally on, okay, how much of this is short OI, how trader short OI, how much is this is trader long. If there are certain strikes where it doesn't change a lot, or it's really clear, like 2650 for a number of weeks there, really clear. Harder to tell for something like 27, harder to tell for something like 28, where it's a lot more mixed. So, right, I would say that this is kind of what I have seen in general. I'm not going to go out and say like, hey, this is definitely what the circumstance is. But if that is the case, it actually means that these near the money call strikes above us are actually going to behave like put strikes, like long put accumulation above us. They're not going to be resistant when approached. They're actually going to accelerate the price up. They're going to be very highly Vanna sensitive. So delta change according to IV. IV is going to spike based on, right, that's what happens when GameStop moves up, right? Volatility goes up. So they're going to be very Vanna sensitive, especially because we have so many that have accumulated for this week. The vast majority of our calls are out of the money, like in excess of 99%. And what I think is a lot of this stuff that's very close to the money, I think market makers, the dealers, are actually mostly long this stuff. So they're holding these long positions. They're holding long calls. Yes, they're hedging those. But they're not, right, because they're forced to buy these contracts. They're not right. They're not necessarily making premium like they would on short contracts. So what I will say in that sense is max pain can be a bit different under this different set of circumstances. Max pain can be higher, right? If you have this huge agglomeration solely of dealer long calls close to the money, then it's something like maybe true max pain is somewhat higher than that, right? I won't speculate too much on this extent, but that is a significant possibility, and we do have. We still had a ton of new contracts kind of come on the board yesterday. A bunch came off. A lot of puts came off. These were weirdly like a lot of short puts came off. 28 was, what was 28? 28 was long call closures. A lot of this was mixed. But I will say that the most interesting thing was to see those 25s kind of pop out. And so we get something like this. So with our gamma exposure, right, we're sitting basically right here, just below 25. So if we can kind of pop up and stay up above 25, then, right, because of all these long calls that were opened yesterday, dealers are going to be hedging these the way that we would normally expect them to. So while we were below it, it's going to serve as like kind of a little lid there. If trading can't push us through there, or if we don't get kind of a bomb kind of drop that kind of yoinks us right through there, path of least resistance is to slip down into like the 24 area, and we do have a lot of long put OI that did build up underneath us there. Right, max pain is right here around 25.50. So dealers will not necessarily want to have these in the money. Right, they profit by having these out of the money best, ideally, and kind of but I guess the 25's in the money, something like that. Maybe close to 25, so they're worthless too because we have net calls there. And we do have a lot of long calls there. But basically, right, what happens is if we kind of start to slip down here, we can get a really, really big buildup of kind of upside volatility here. If it can crack 25, then if these positions here, and I think this might be the case, I think 26, 27, 28, 29, I think most of these positions in here, I think they're net trader short. I don't think they're net trader long. I could be wrong, right? And I'm not going to say, right, this is not financial advice, this is not trading advice. But if that's the case, then they're actually going to behave like puts would on SPY, like long puts would on SPY. And so this is going to be kind of a combo gamma Vanna ramp to the upside if it can get the right kind of volume to kickstart things. Then it will ramp up pretty hard and it will continue up basically, yeah, basically so long as there is continued buying volume. You know, look at, like, you can see just how much GEX we kind of have stacked on top of ourselves right here. For example, if we were to get something like if Roaring Kitty were to tweet today or something, I could see this go in, like this could go here, like it could go up to like 29 is the thing. If Roaring Kitty were to tweet today, I don't see a reason why he would. Not that I would necessarily know, but I'm trying to provide like an example here of the type of catalyst that would provide this type of price action. If we saw something like that, then I think we could get the type of buying euphoria that would come in, and then, you know, dealers or institutions would be super happy to squeeze all of these traders really quickly out of their short calls. Maybe they would hop out, right? They would try and close them, and then those traders, the short traders, would then turn around and they would provide the liquidity to buy the calls, right? They would buy calls on the way up. They would provide then the buying impetus to really get that going. That's sort of the biggest scale version of this. A small scale version of this is an institution, kind of we walk down, we're kind of hanging out around 2470, 2450. An institution comes in, drops a couple mil, gets us over 25. You know, some of this market maker gamma hedging and Vanna hedging brings us up, right, by buying, right, by buying. And we sort of get into the 2650 area before kind of cooling off into 2550 if this is somewhere between 25 and 26 for a max pain finish, something like that, right? Like I said, I skipped over our technicals part, so I'll kind of double back there. We kind of do, right, we have the kind of makings of a new consolidatory channel here. So this would make sense for us to kind of start moving back to the upside here. Kind of 2650 area is basically right here where this historical price level is. Move up here to the 54-hour moving average, which we touched, right, basically on Monday. Monday after hours, I think. Tuesday after hours, I think. So to form something like that, and then even if we're going to continue down later to kind of deflect off of this resistance line in the bearish regression channel, that would make sense to move up here. If we zoom out a bit, look at our daily, we are as close to the 200-day moving average as we have been through everything that has happened since May. This is yesterday was the closest we got to that level at 2453. The last time we even touched this level is when we used it as a support way back in May. Way back in May. So this was before Roaring Kitty's return. So if we're looking at this from a technical perspective, if we're looking at this from our options data perspective, and if this hypothesis holds up, basically that we have a lot of traders who have been selling calls pretty aggressively into strikes that are pretty close to where we are, and recently that expire this week, we have a pretty sensitive environment for some recovery today that could be pretty explosive, right? What I would say is, if this does occur, I would not expect this to be something that holds for a considerable period of time. I could see this as something, one of these Friday gamma ramps that gets people excited only for market makers to then use this massive pile of short liquidity. Right now we're up to 2.5 million shares available to borrow, to then walk it back down. Everybody gets excited, buys a bunch of calls, and then crush it back down again into another kind of flat period through the end of February, mid-February into the end of February, and then sometime a couple weeks after February OPEX, we get some real excitement again as we ramp up for earnings, something like that. But just throwing this out there, pointing out things I see. Like I said, not trading advice, not telling you to go out there and trade this, not investment advice, not telling you to go out and buy GameStop right now because it's going to the moon, today. Not my point at all. But certainly, if you do see something like this, it is my understanding that if something like this does occur, these are the dynamics. What I've just laid out here, these are the dynamics that are driving that. It doesn't have to occur, right? We could just kind of trade flat. We could just kind of go down a bit and then kind of come back up, right? Somebody doesn't have to spend the money to make this stuff happen. But if you do see this happen, these do look like the mechanical factors that are in play that would bring about something like that. So yeah, so that's it for today. I should say that's it for this video. We do have our live stream coming up today, our weekly live stream coming up today after market close. We are going to, on account of time zone difference, we are going to do today's live stream. It's going to be my European audience, right? My Euro friends, EU friends, you'll have to forgive me. We're going to be doing it at 7:30 p.m. Eastern time, so about 3.5 hours later than we usually do it. So that's going to be still after market close, but rather than happening at 4 p.m., it's going to happen at 7:30 p.m. Eastern time today, Friday. So after market close. Yes, I know that might be a little late for some of our Euro friends to stay up late with us, but maybe we'll be able to get some American folks who maybe aren't off of work yet on Friday, typically at 4 p.m. at market close, to pop in. So look forward to seeing you guys there. We'll reflect on this week. We'll look forward to what we have coming up. We'll spend some time. Richard Newton's been putting out some really great stuff, some really great concepts this week. So I definitely want to, if you haven't had a chance to check out his stuff, number one, go check it out. But I do want to take some time to discuss some of those things that he's been really great to point out. So I think it's worth bringing to your attention and sort of working through my own attention as well. So look forward to seeing you guys 7:30 p.m. Eastern time. The link should be live already on my YouTube page. So I'll post a reminder over on X. So thank you very much, everybody. We'll see you. Yeah, we'll see you in a few hours. So enjoy the day. Take care.